All right, everybody, welcome to our monthly production stream. This is the July edition. Thanks for joining us. Before we get into any of the content, first, I want to say our thoughts at East Daley go out to those affected by the storms and floods in Texas. So first things first, who's joining me today? I've got Gage on crude, I've got Jack and Oren on nat gas, Maria talking production, and Julian talking NGLs. Thanks for joining me, everybody.
Thanks, Chris.
All right, clients, we got a new benefit. If you look in the upper right hand of your portal, you'll see Daley, your new AI partner. So what Daley's really good at right now is searching all our content and rolling it up into actionable insights. What we're still adding to Daley is all of the charts, all of the data, but we're doing that daily. So Daley is going to improve daily. All right, what we do for everybody out there, we take hundreds of different data sets, and our goal is to take you from the wellhead to demand for every commodity and show you all the points at which folks are making money, taking deliveries, adding to the system, and then reverse you around and take you from demand back up to the wellhead so you know where your supply is coming from. So let's get into the agenda. First, we're going to talk production, one market, many moves. That's going to be Maria. And then build it and we'll flow. There's a lot going on in the Northeast and the Southeast as far as super build. And it's nice not to just talk about MVP in the Northeast anymore. Jack will be doing that. And then Permian, battle of WTI and Waha. Permian is drilling for gas. Oren's going to jump in. We're seeing some interesting trends in where rigs are being deployed. Gage is going to jump in with Canadian crude constraints. Again, back to build it and they will fill it. And then when ethane sets sail, does anyone care? This is really a play on the battle of what's going on. We're still producing ethane. Who's going to take it? What does that look like? And then the production scorecard. That's by basin. So let's dig in with Maria on production. Maria, give us our month-over-month look.
Okay, Chris. So starting with crude oil, we're projecting an average of 13.4 million barrels per day, and most of the month-over-month variation is driven by activity on the Bakken Basin, which under the current price environment is expecting slower growth than what we forecast last month. Switching to natural gas, we anticipate dry gas production averaging 101.5 BCF per day, and the big three regions, Permian, Northeast, and Arctic, are still dominating the market. On the natural NGL side, we're forecasting 7.3 million barrels per day on average, and the Permian and the Mid-Con are the key source of variation here.
All right, so that was our lower 48 look. Let's kind of dig into what basins had the biggest change.
Yeah, so to summarize, across all the U.S., WTI price sensitivity continues to be the key variable across all basins, and the Permian remains the central driver for all commodities. So no matter if you talk about oil, gas, or NGLs, you have to eventually look at the Permian. On the crude side, as we mentioned, the Bakken is the driver. With the current price environment, we see that on the core, we have reduced around 5 rigs, so 35 at the beginning of the year, and currently we're at 30. So that basically counts the decline on production. On the nat gas side, we adjust our Arctic ramp to reflect the current rig environment tied to the Henry Hub prices, and we think that in the coming years, tier 2 basins could help balance the market with added supply. And then on the NGLs, we have Permian and Mid-Con. On the Permian, producers benefit from vertically integrated supply chain, which basically grant them a comparative advantage. And this integration enables flexibility to respond to market prices fluctuation. On the other side, on the Mid-Con, is closely tied to natural gas production levels and frac spread dynamics, and that makes it a little bit more sensitive to commodity price movements.
So our next section, build it and it will flow, talking about the Northeast, Southeast super build, and then we'll move into Permian, Canadian, and ethane development. So Jack, you're up first. Let's talk about the Southeast Gulf infrastructure projects.
Yes, let's definitely talk about this. This has been the center of midstream infrastructure projects for really the past couple of years. So what we're looking at here initially is what has been going on in 25 and what we expect in the next couple of quarters here. So two biggest projects here are right at the top. Louisiana Energy Gateway, a Williams project that will move gas from the Haynesville down to the Gulf Coast. We expect that in Q3 coming up here. So potentially as soon as September, which would be a huge development. Then you have the Momentum NG3 project, another 1.7 BCF a day of capacity to move gas from the Haynesville down to the Gulf Coast. Combined, that's 3.5 BCF a day of capacity to feed growing LNG demand. We don't expect it to flow all at once, but it will get there as projects roll in over the course of 26. Coming up in 2026, the big dog, Blackfin Pipeline, which is basically going to extend Matterhorn's reach to the Texas border. That's a big project, big greenfield project, and not to be confused with Blackcomb Pipeline, which comes in a little bit later next year. Between Blackcomb and GCX, you get an incremental 3.1 BCF a day of capacity to move gas out of the Permian down to the Texas Gulf Coast, where there is growing LNG and power demand there. So a very useful pair of projects there. Lastly, the big dog on here is the Rio Bravo pipeline, also expected in Q3 26. That is pretty much dedicated to feeding the Rio Grande facilities as they expand out their LNG deliverability capacity later in 26 and 27. In 2027, you've got projects that serve a variety of purposes. So first up is Trident, which is basically going to move gas over to Golden Pass LNG to further support that facility's development. Then you have Pelican, which is nearly in the same trench as NG3 and LEG, another nearly 1.8 BCF a day of gas moving from the Haynesville to the Gulf Coast. Hugh Brinson is a demand-driven project, but not LNG, more related to data centers and emerging power demand growth in the Dallas-Fort Worth area there. And then lastly, you have Traverse, which is kind of a flexibility pipe. It allows you to move more gas basically between Agua Dulce and Houston Ship Channel, have that flexibility to basically kind of ship Eagleford gas, that low nitrogen gas, to kind of wherever you want. Several interconnects there, very flexible pipeline. Then you have two projects coming up at the end of 28 and the beginning of 29. The Kazi Boardwalk project, Kazi Junction, and then Kinder Morgan's Mississippi Crossing project are both aimed at Transco Station 85. A very expensive point now with Florida and Georgia utilities demanding more gas. And then layer on to that Plaquemines Phase 2. We call that the knife fight, and those two projects basically aim to be able to deliver up to 3.6 BCF a day of more gas into that corridor.
You know what's interesting, Jack, is we've talked about this for a while. We had a few things that were happening. One is, how do you get the gas to Louisiana from Texas? And then two, how are we going to power all the power needs, population growth in that southeast area? And it's fun to watch this all come together. It'll be interesting to see how it all plays out. We went through this with LNG, remember 2 years ago, where all those announcements were happening, and timing is everything. And so it'll be interesting to watch how this plays out. But let's look at the Northeast, where we can talk about something other than MVP.
Thank goodness. I mean, I love that pipeline and everything, but in 25, towards the end of this year, basically what you're getting is a lot of interregional build out to serve growing demand, primarily from power, not necessarily all for data centers, but also for growing population centers in the Carolinas and Virginia, right? Ohio Valley Connector is a big project there to basically unleash more gas, kind of out of Ohio onto more mainstream pipes. Things like Commonwealth and Virginia Reliability really just allow more gas to move off of the main line there at Transco and onto different projects. In 26, really not a lot of action. You've got a small ridgeline project there to deliver more gas to TVA projects there in eastern Tennessee. And then in 27, this is when like the hammer drops, right? And that hammer is Transco's Southeast Supply Enhancement, 1.6 BCF a day to get down into Alabama and Georgia there, really to kind of increase the flexibility on the east side of the Southeast Gulf region, and also bring more gas, potentially to Plaquemines and Georgia and Florida utilities.
Would that be Station 85? That will affect
Ish. Yep.
Ish.
Yep.
Okay.
Yep. And then we've got a couple projects in 28 that are related to MVP. But we'll just call them Southgate and a compression expansion. What this basically allows MVP to do is expand capacity southwards to the tune of about 1 BCF a day or so, 500 combined on each of those. And then in 29, you got some interesting developments as well. The most controversial of which is probably Project Maple, which would move gas into New England to basically capture that premium at Algonquin. Hotly contested whenever you try to build a pipeline into Massachusetts across the Hudson River. So we'll see how those developments go. In 2030, you have Boardwalk's Borealis project on TGT, which aims to bring more gas from eastern Ohio to western Ohio. What this allows TGT to do is basically move its null point further south so that it has more flexibility around that southeast Gulf demand centers, and eventually drop more gas into that system further south. Transco Power Express is a project aimed squarely at Prince William and Loudoun County data centers, again allowing that flexibility to go north and south on top of those compression and Southgate projects. And then you have some other things that we have listed out as spec pipes, right? There's no open seasons yet, just a lot of talk. Probably what has garnered the most attention there is Constitution Pipeline, certainly heralded by the Trump administration and certain producers. It's a producer-driven pipe, unlike the Millennium Pro and Transco Nessie projects, which are more utility-driven. Lower capex on those projects there than Constitution. So if we had to pick winners here, we'd probably go with Millennium and Nessie over the Constitution project.
All interesting stuff, and it's going to be fun to watch as this gets built out, what happens with prices, and producers are drilling into it. So let's move on. Oren, the Permian, it's tied to WTI, but I don't know. It's looking more Waha-ish here. So let's look at what rigs are doing down there.
Yeah, so, like we said, recent geopolitical volatility, namely tariffs and conflict in the Middle East, has really depressed the WTI forward curve and has led Permian producers to collectively cut CapEx guidance by over $2 billion. In our forecast, that equates to reductions of roughly 400 million barrels a day of crude oil and nearly a BCF a day of residue gas by the end of 2027. If we assume that WTI continues to inform producer activity, we're going to have a lot of empty pipes out of the Permian, over 4.5 BCF a day of FID new egress capacity, as Jack just showed. However, U.S. gas markets are not slowing down. We expect to see the market expand by over 20% by the end of the decade, led by LNG and data centers. And this new demand will pull on every gas basin because we need all the supply we can get. And there's a lot of gas left in the Permian. Recently, Diamondback Energy said that there was 5 to 10 BCF a day of available Permian gas growth, provided there's sufficient egress capacity and price to support that development. In our view, the combination of increased Gulf Coast LNG demand and unconstrained Permian egress will strengthen Waha sufficiently to incentivize that gas-directed development. We recently ran a scenario looking at Kinetic's Alpine High system, one of the gassier Permian gathering systems, and found that just 5 additional rigs could add as much as 1 BCF a day through 2030. And Alpine High isn't even the gaseous system that we track. Both XTO and MPLX's Delaware systems post higher initial production rates. And so to summarize, we see an end to the long-standing WTI-driven associated gas regime. And while this represents a significant paradigm shift, it also continues an ongoing trend of CapEx redirection towards the Delaware. Over the last 2 years, as total Permian rigs have fallen by over 100, a higher proportion have moved from the oilier Midland subbasin to the gassier Delaware. And we expect this trend will only accelerate as LNG tailwinds coalesce in the Gulf.
Awesome observations there, and it's interesting to watch. And yeah, Waha is coming in. If you followed us for a couple of years now, you'll know that we talked about commodity ties a couple of years ago and how optionality was going to be key for producers and infrastructure alike. So let's bring in Gage, jumping over to Canada. They built TMX, and now we're starting to see a constraint, Gage.
Yeah, I mean, there's the possibility of it there, Chris. And so, like we had said earlier, and what Oren talked about on the Permian side, if they build it, they will fill it. So we had been asked by our clientele to really try to dig into the different supply side aspects from the crude qualities up in Canada. And so I'm happy to be able to share that we've been able to dig into the different qualities and the different production that is making up the marketable supply in Western Canada. And highlighting this today, we're really then seeing that come the end of 2027, there's going to be some constraints. There's an increase in forecasted supply of about 595,000 barrels a day by the end of 2029, and that's really driven by in situ bitumen production, which is going to be about 364,000 barrels a day by the end of 2029. And there are some other qualities, some other types of production that is feeding into this marketable supply as well, but nothing quite as superior as the in situ bitumen. So with that supply forecast in mind, there's then the idea that the pipeline egress will be constrained by around the beginning of 2027. And that could really pose some issues for the Canadian producers, those midstream companies, and any of the traders as well. Leaving crude stranded in Alberta will make WCS trade deeper at a deeper discount to WTI. The producers might be forced to cut their production, or you have to put the production on a rail car versus on a pipeline, which ultimately it costs more and it's riskier. And I think we are seeing the midstream companies react to this, and they're doing it sooner rather than later. There's talks from Trans Mountain with the Trans Mountain expansion already being filled up that they're going to blend DRAs into the crude stream, which you can get they'll get about 5 to 10% more capacity out of that system. And then Enbridge is also planning a 2-phase expansion on Mainline, as well as a 30,000 barrel a day expansion on the Express Platte system. And all in all, that'll get you pretty close to that 595,000 barrels a day of growth that we're seeing out of Canada.
Oh, Canada. Yeah, getting interesting across the board. And Gage, congratulations. It's not easy to say in situ bitumen on a webinar 5 times.
Thank you.
All right, Julian, let's bring in ethane, still the most interesting story for NGLs. And we thought maybe we had it solved, and now it's getting interesting again. So what's happening?
That's right, Chris. Ethane just goes up and down, and the market loves it. But there's been a lot of just focus on ethane recently due to export restrictions. And while those restrictions have come off now, the ethane market is kind of a hinge point where we've exposed a structural dependency on U.S. ethane. There is nowhere else in the world where you can get ethane at scale. So if you're a company or a Chinese petrochemical company and you saw all of your ethane supply just dry up in a matter of a day, well, suddenly you're kind of rethinking your whole strategy. You're rethinking your billions of dollars of investment. And if you're a company somewhere else that are thinking about investing in U.S. ethane, you're also rethinking your strategy. You're thinking, is it safe to bet on U.S. ethane? So where we see this going, there's three scenarios: demand plateau, treading water, and expansion cycle. So that's either demand plateau, where demand kind of slows down. Ethane is kind of seen as too politically risky, and the smart money moves away. Or the treading water, where it's kind of a little moderate, where demand still grows, but you're smart about your contracts. You build more flexibility into your contracts. You invest more flexible feed crackers, for example, that can take naphtha, ethane, and LPG, so you're not wholly reliant on one source. And scenario three is where the expansion cycle, where we see a huge growth in ethane demand, because frankly, it is the cheapest feedstock on the market, and there's plenty of it available. In the graph in the bottom right, by 2030, this is kind of a scenario two graph where we still see some recovered growth. But even in that scenario, you know, there's 650,000 barrels a day of recoverable ethane that will be rejected into the gas stream. So ethane supply is not an issue. It's just how the market builds into it, and how does it build into it smartly.
So one thing, or two things really, Julian, you pointed out, no one can replace, and I think this is a point we make every webinar, no one can replace the supply of ethane from the US. There's just no other place to get it.
Yeah, that's right, Chris.
And also going back to the super build and the time it takes, if we start rejecting ethane into gas supply in some areas, there might not be the egress to get it out either. Is that correct, Jack?
Yeah, I mean, the more ethane you inject, the fuller those pipes get.
Yeah.
Within operational limits for sure. So certainly, you know, if we're in that, you know, demand plateau phase, you'd see, you know, more ethane in the gas stream, you know, potential ramp in gas production, and faster filling pipes.
Sounds like commodity ties to me. So let's look at our production tables to close this thing out. Maria, bringing you back in. Crude, one thing, Bakken, we talked about, but the Permian, after 2 months of decline, seems to have steadied.
Yes, I think producers already react to the extent level they could to the price environment. And looking at producer guidance, it seems like they will keep at this level, so we can basically say that we had find the new Permian outlook that we think is correct. And that's why you don't really see changes month over month.
All right, Permian's there, and now we jump into nat gas. We still have Permian flat, but we may see that change as egress comes on. But what are the major changes here?
I think it's Mid-Con, we have seen slightly more rigs on the area, including Anadarko or net. That's what we constitute as the Mid-Con. And then Eagle Ford and Northeast are relatively flat. It's just like fluctuations on the rig count, basically.
And then natural gas NGLs, we've seen some change there? Any commentary here?
I think it's basically, again, the Mid-Con, like you see gas increasing, then NGLs would increase, and then the Bakken and the Permian is that vertically integrated chains in which producers can or have more flexibility to react to different commodity prices, because they, at the end of the day, get better TNF pricing for their product.
Yeah, thanks for bringing that up with vertically integrated. For any of you who want to learn more about our view on that, download our dirty little secrets from this year. We talked about integrated is getting more integrated, how optionality and capturing value chain was going to be big as we move into this growth. So this is our free content. Please subscribe to that. Here's the team. And as we always end it, what are you looking for during the next 30 days before we do our next webinar? Maria, I will ask you first.
I think continue seeing that commodity ties, like we see it on this webinar across like nat gas, crude, and NGLs, and then also how like geopolitical factors impact our production scenarios.
Awesome. Julian, I'm going to turn to you next. What are you watching for?
Chris, what I'll be watching for will be international petrochemical build-out. Are they investing in flexible crackers? Are they going ethane only, or are they switching completely away to naphtha or something else? And that will kind of tell the state of the market.
Great. Gage?
I'm looking to see if the Hemorrhage and Energy Transfer Southern Illinois Connector Pipeline actually comes through this time.
What do you think?
We'll see. The last project that Energy Transfer had, I don't think it went so well.
All right. Always hedging.
Different partner this time, though.
Yeah. Oren, what are you watching for?
I'm keeping an eye on Plaquemines feed gas. A couple years ago, we made the call that, during peak summer demand in that southeast region, we'd only see, there was only about 2.6 BCF a day of available gas supply. This spring, Plaquemines, ramped quickly up to 2.8 and has since kind of tapered back to 2.5 BCF a day. So far, our call is looking good, and just hoping we're right.
Interested to hear more. And Jack, what are you watching for?
Restoring my youth so that I can keep up with these.
It's too late, buddy. In the oil and gas.
I mean, just look at those hairlines, right? So yeah, as it relates to gas, and I know we didn't touch on this exactly, but what I'm looking at is the last week of July and the first week of August to see, what our end of season storage trajectory looks like. If those injections come in higher than expected, then we are, firmly on our way to lower prices to finish summer, going into winter.
All right, Jack. So I know you're a betting man.
Mm-hmm.
Higher or lower than the expected?
Well, I only take bets that I know I can win.
Okay.
And I, at this rate, all the evidence has shown me leading up to this that injections are likely going to be higher than certainly last year, and potentially at the 5-year average pace, which would put us at a little bit closer to 3.9 TCF and 3.8 TCF to end the season, with some downward pricing pressure associated with that.
And shameless plug, if you would like to know exactly where we're coming in on our storage injection numbers, it is in our
macro S&D, baby.
And you can buy that online. Go look for it. So anyways, everybody, feel free to reach out to us if you have any questions. Again, thanks for joining everybody here at East Daley. Thanks for joining me on this. It's always fun.
Thanks for having
All right.
us, Chris.
Great deal.
All right. Thanks, guys.